Hey everyone, it's Alex Morkate with Real Estate Shorts. Today we're going to introduce the topic of cap rate in commercial real estate. By the end of this episode, we will cover what it is, how it's defined, how it's applied, and what it really means to you. Let's get into it. All right, so first things first, what is the cap rate? So a cap rate in commercial real estate is probably easiest defined as a ratio. It's this relationship between net operating income and the price or value of a property. So I know most of you are thinking that's such an easy concept, and honestly, mathematically it is. But I think its application and the underlying principles that drive its application are what make it a bit more complex. So we'll dive into those briefly now. So if we understand that it's income divided by price, that will help us determine some kind of return relationship in commercial real estate, I think we need to dive a little further first. So I think the first thing we need to keep in mind is that obviously it's a return metric. It is a return metric that will represent itself as a decimal or a percentage point, and this is going to be a return metric that shows a snapshot, typically a 1 year point in time return. So it doesn't look ahead into the future very far, and it certainly doesn't give you any global return perspectives from the entire investment opportunity. It's really just a snapshot relative to income. So to illustrate kind of what this relationship really does, the inverse relationship of the cap rate is the driving force behind its application. So we'll dive into that next. So in the example we have here, we have $80,000 worth of net operating income in a price of $1.2 million. And so if we were to divide $80,000 into $1.2 million, we would get 6.67%. Now, let's see what happens as these numbers begin to change. And it's probably easiest if we keep NOI constant and we begin to toggle what happens at different prices. So let's say, for argument's sake, instead of it being $1.2 million, it's really just $1 million. So cap rate goes up. So this is an example or an illustration of that inverse relationship, where for the same amount of income, as price goes down, cap rate goes up. And that inverse is true. As price goes up, cap rate goes down. And so imagine yourself in this auction and you have 10 other investors around you. If the price starts to get bid up, that's a signal of demand for that property. If the price starts to increase, that's a signal that there are a lot of investors who are willing to take the risk that's present in that investment opportunity. So what really ends up happening is that as price goes up for a constant amount of NOI, you'll tend to see a decline in that cap rate. And that should make sense. As more investors are willing to buy into that opportunity, they're proving that there isn't as much risk as other options. So cap rates decline. And again, the inverse is true. If there isn't a lot of demand, and if there's a lot of risk, people should be compensated for taking on that risk. Cap rate goes up. And I think this is where we begin to open up that big Pandora's box of that relationship between risk and return in both the cap rate and really in commercial real estate in general. So let's move on. So how is it applied? There's really just two circumstances in which cap rate's applied. The first is at the time of acquisition, so the going in cap rate. So what cap rate could you expect to earn in that first year of owning and operating the property? The second circumstance is what happens when you're preparing to sell the property. And the logic goes something like this. If you are a rational investor, and so is everyone else, and for your sake I hope you are, then you're likely going to purchase based on the cap rate that compensates you for the risk you think is present in that deal or property. So in this example, it's 6.67%. You feel comfortable accepting that rate of return to compensate you for the risk present in this property. So this could be market risk, tenant risk, building risk, capital risk, you name it. Now let's say 5 years go by. You've owned it, you've been a good operator and a good manager, and you've been able to increase net operating income. So I think it's rational that you would come to expect a higher price. There's more income. So let's see what happens going out, because this is really where that rubber hits the road. In the same way that you purchased the property with the expectation of this cap rate return, other investors will purchase it from you with that same expectation. So they will look to your income. They will evaluate the risk of the property, of the income, the tenancy, of the market, and so on. They will determine the cap rate that's appropriate to them at that time, and then they'll offer a price accordingly. So let's see what happens in that going out circumstance. Let's say you have $100,000. At a 7% cap rate, the property is now worth 1.42, almost 3%. So again, we'll take NOI, and now in this case, we'll divide it by cap rate to arrive at price. Now, what happens if we begin to toggle? What happens if we begin to increase or change? So if cap rate goes down, implying that there's less risk, maybe you improve the tenancy, maybe you improve the quality of the building, maybe interest rates are low around you, maybe the market has improved around you. In any event, or in the combination of any of these, let's say cap rates decline. As cap rates decline or fall, now we see an increase in price. We go from 1.4 to $2 million. The opposite would be true. If there's more risk, investors aren't going to be willing to pay as much because there's more uncertainty, there's more risk. And so now let's say cap rate is 10%. Now they're only willing to offer you $1 million. So the same logic is going to apply either on the front end going in or on the back end going out. But these applications are a little different in that the first helps you determine the price that you would potentially want to pay when you purchase the property. But the second helps you establish what you think you can sell the property for at some point in the future, assuming that there's a market full of rational investors who will apply the same logic you did when you bought the property. So to nail home some of these key points, the inverse relationship is really what drives the application of this cap rate. So lower the cap rate, higher the price, and vice versa. Now, I think it's best to remember that obviously every seller is going to want to sell at the highest price possible, and every buyer is going to want to buy at the lowest price possible. So what does that imply? Every seller is going to want to sell at the lowest cap rate possible, and every investor is going to want to purchase at the highest cap rate possible. So let's split that apart for a moment. Let's say you are this investor. If you are the investor trying to purchase the property from me, you will come back and offer, let's say, $700,000 on this example's property. So let's say it's $700,000. You'll want to earn 11% plus, more than that, right? And I think whether you have a solid foundation to justify that return requirement, or you just simply like the way that that number looks on paper, you're likely going to want to offer as little as possible. By offering as little as possible for that same stream of income, your cap rate will be higher. As the counter example, let's say I respond to your offer and say, there's no risk, there's a new long-term lease with a good credit tenant, with a lease guarantee, the market is accelerating, population growth and demographics are strong, and I list all these factors that signal that there's less risk in this property today than there was yesterday, then I'm making an argument that the cap rate that I was asking is justifiable and yours is too high. So I would respond to your 700 and say, how about $950,000, or how about $1 million? Because there's less risk than what you believe there to be. And this is really where that negotiation comes into play, where we start to tell each other our rationale or understanding of that risk benchmarked against certain factors or qualities. So the tenant has 10 years left on the lease versus 1, or the tenant is a national well-known tenant versus an operator who's never had a shop before. As we explore a lot of these risk and return, call it factors or qualities, this is really where a lot of that negotiation comes to paper. All right, so as we begin to wrap up, What we've covered is first the definition of a cap rate. We've begun to explore its application in two settings, going in and going out, so at the time of purchase and at the time of sale. And then we've illustrated how that inverse relationship applies to you and how you could use it to apply to your future investments. If this video was helpful, I encourage you to take a look at other related videos that help build on this topic. As always, if you have any questions or if you have any comments or feedback, would love to hear it, and I look forward to talking to you again. See you soon.